So today we're joined by Mitesh Parikh, who's the global head of macro and fixed income at Schonfeld, one of the largest hedge funds in the world. Thank you for joining us today, Mitesh.
Thanks, Aman. Excited to be here today.
So you've been in finance for nearly 25 years now. Can you first explain to us how you began finance? Where did you start? In what industry, etc.?
Yeah, you're putting some age on me yet. So I started in finance in 2002. I started my career at Goldman Sachs. I was in the currency trading department at Goldman. That was back in 2002. I was there for just over 14 years. And by the end of my tenureship there, I was running the global currency trading business and front-end rates. I knew at some point I was always going to go to a hedge fund. It was just kind of, how I was geared in terms of how I thought about risk and where I saw my career. And having thought about a number of opportunities in the early part of my career at Goldman, when I started feeling my learning was plateauing a little bit, the opportunity came to join Balyasny. Some of you may know Balyasny is a big multi-strat. It's actually a competitor to my current firm. Indeed, Dmitry Balyasny founded Balyasny Asset Management, spun out of Schonfeld, in the early 2000s, and now our firm and Dmitry's firm kind of compete for talent, and very similar in our setup. I spent just over 4.5 years at Balyasny. I kind of really helped build out what then was quite a fledgling macro fixed income trading business, and also really was focused on developing talent. So we created a program called the Anthem program. We identified exceptional young talent that I worked to mentor and develop as part of my kind of a time at Balyasny. And then really in 2018, I made the decision to kind of branch out my own to launch my own fund. So I actually moved to Dubai. That's kind of what first brought me here. Much to the bemusement of a lot of potential investors at the time, kind of questioning why Dubai. It just wasn't on the hedge fund map at the time. But look, sometimes in life you need a little bit of luck as well. And for me, COVID was really a turning point. We had a good start with the fund in 2019, but we're able to kind of identify the risks around COVID. Really made a lot of money in that kind of COVID period, early into kind of European equity shorts and various other things. And look, from there, the fund didn't really look back. We kind of raised a lot of capital. Dubai became a major center for finance just because, people were less concerned about geographic location. And then in 2021, my current partner at Schonfeld, Colin Lancaster, who kind of hired me to Balyasny from Goldman back in the day, decided to partner with me to kind of expand our fund. And just as that was happening, we were raising more capital. Schonfeld approached us to come on board and work with them to really build out their macro fixed income business, which at the time was not an area that they had specialism or exposure to. So it's now been 3.5 years. Really pleased to say that it's gone really well. Certainly exceeded our expectations in both the pace and growth of building out the business there. We now have close to 40 portfolio managers running around about $11 billion of kind of allocated capital, what we call kind of 20 pods, diversified across, tactical macro directional strategies, credit, more liquid end of credit, US high yield and investment grade. And then we also have, more kind of an RV strategy, so bond RV and kind of more traditional swap RV, off-balance sheet type strategies.
So how has your perspective of the hedge fund industry evolved over the years as you've obviously progressed in the sector?
Yeah, look, I think there's a couple of ways of thinking about that. I mean, one, the hedge fund model's been around for many, many years. You think about, going back to kind of the 80s and 90s, really famous hedge fund managers like Paul Tudor Jones, Alan Howard came along a bit later in the early 2000s. Bruce Kovno founded Caxton, but these were traditional macro hedge funds, very top down and focus, very concentrated exposures, really run by, really a CIO, a sizable CIO that took the bulk of the risk. The model was very different as well. Like, it would be a traditional kind of 2% management fee, around about a 20% kind of performance fee type model. I think really kind of post-financial crisis, the evolution of hedge funds changed quite significantly where, you really saw the growth of the multi-strategy model. And when we talk about multi-strats, what we're really talking about are very diversified hedge funds that have multiple different types of strategies within them. So that could be an equity trading strategy, in our case, a quant or stat-arb trading strategy, directional macro and fixed income, like the business that myself and Colin run, or more tactical ECM, DCM, debt capital market type strategies as well. So it's very diversified, and you have pools of traders that are managing that money. So it's not really one individual, it's multiple risk takers that have generally quite high sharps, that are quite diversified from one another. We try not to kind of run too much concentration risk. And the objective is really to produce high quality risk adjusted returns in all market environments. So you think of, the big multi-strats out there now, they really dominate in terms of both their size and scale, in terms of what they're able to kind of produce. And you look at Millennium, you look at Citadel, Point 72, Steve Cohen's kind of a famous firm, ourselves, Balyasny, there's multiple others, but all of these firms have one thing in common, and that is they have very good risk-adjusted returns in all market environments at a fraction of the risk of the S&P. So, in periods like 2022, where the equity markets were down 25% or so, all these firms performed incredibly well. 2020, summer environments where volatility is exceptionally high. Most of these firms had exceptional risk-adjusted returns in these types of periods. And that's really what kind of big investors are paying for, to be able to compound wealth and generate returns in all market environments. And I think that's really been the evolution of hedge funds to become more consolidated, larger in size, very, very diversified, and complexities increased quite significantly over the last kind of 20, 30 years as well.
Yeah, I mean, I think with hedge funds, a lot of the time there's criticism, because in some years when the S&P is doing very well, hedge funds might be, providing similar returns, sometimes slightly more, sometimes slightly less. But of course, that goes back to whether you're going for a multi-strategy or a single strategy fund. But then during those downward years, when the stock market and equity risk on equity markets are collapsing, and everyone's just losing money, drawdowns 25%, the hedge funds in those years are still providing the returns with less risk. Providing sort of less risk adjusted returns, or adjusted for risk. The returns are actually much more impressive because you're always like trading in and out of it. Now, as someone who's looking to invest to keep their money with a fund manager, why would I invest? Why would I trust a multi-strategy hedge fund manager rather than a single strategy?
Yeah, look, I think a couple of things. The track record is just, these firms have been around a long time. So, in our example, the firm has a 37-year track record. It's never had a down year, despite all the volatile environments we've seen. Our flagship fund, the Partners Fund, has been around for just under a decade. And think about the number of things that have happened over the last 10 years, be it, we had Volmageddon in 2018. We had a big blow up in the repo market in 2019. We obviously had COVID, which saw unprecedented volatility in that period. We saw the Trump election in 2016, Trump 1.0. We've seen the recent Trump election. We saw the fastest hiking cycle we've seen in recent history in 2022. So, so many different types of events, yet all these firms have performed incredibly well on, in some cases, a 2 to 3 sharp. And look, historically, off the top of my head, I guess the S&P is probably a 0.8 sharp or something like that. So to your point, like the risk-adjusted returns do matter. And the types of returns on average produced are somewhere in the 12, 13, 14% range, and some firms even higher. And these are after fees. So if you think about being a big pension fund or a big sovereign wealth fund, and you want diversified exposure where you don't take too much market directionality in that exposure, one of the big reasons to invest in multi-strats is, one, obviously the proven track records, but two, just the complexity of these businesses. You have the top portfolio managers, and look, the fee structure, one of the things that is kind of leveled at the industry, is very expensive because we have something called the pass-through model, where investors ultimately do pay PM compensation, and various other costs associated with running the business. But the quid pro quo is that allows us to hire the best talent, to retain the best talent, to invest in technology, infrastructure, the best risk managers, to really think about how we scale these businesses in orthogonal and diversified ways that continue to improve the quality of the return stream that we have. And, we've seen it historically. The flip of that is that if you don't perform, then investors, of course, have the right to vote with their feet and will pull. So, you can't be an expensive platform if you aren't producing high quality returns. So I think that's really why investors are very focused on multi-strats. And look, I know for myself, I started my own firm in 2018, and look, we did pretty well. Like, we got to, very quickly just shy of $1 billion, and with Colin coming on board, the capital was coming in much faster as we kind of were thinking of expanding to a multi-manager platform. But the calculus I did in my own mind was that even if I get to $2-3 billion of AUM, which sounds quite glamorous and sounds like a big firm, and it is a big firm in hedge fund space, the reality was you're diluting yourself to bring in big investors, to kind of give you sticky capital to start with. The second thing is you're always competing with the big multi-strats of talent. And, my mind was, even if I could attract good PMs, which I thought I could, the top PMs, why are they going to leave a Point 72 or a Citadel or a Millennium to come and work, as much as I'd love to at my own firm, unless really they, one, believe that you can really scale to big size, and two, are going to get some equity in the business. And, so they're big bets to make. You hire a PM, you give them equity, it doesn't work out, then you've diluted yourself and, you're stuck in that situation. So I think to compete with the multi-strats has just become harder and harder. And my bet and Colin's bet was that, going into somewhere like Schonfeld, where the culture was exceptional, it's super collaborative, we'd be able to build and scale our own business much, much faster, and leverage all the benefits that a big platform like Schonfeld already had. And, that's really what the bet was. And, it's 37 months into our track record. We've been positive in 31 of 37 months. For a macro fixed income business, I think we run an incredibly high Sharpe. It's just north of 3, which is generally unheard of in most macro fixed income businesses, especially ones that aren't just short volatility or kind of bond RV type strategies. We have some of that exposure, but it's certainly not the bulk. I don't expect us to continue to kind of annualize at that type of Sharpe, but nonetheless, our objective was to build an all-weather macro fund, and so far in 3 years of track record, that's what we've done. And more importantly, continue to add diversification benefits to Schonfeld for other businesses like the equities business or like the Statar business that do have a tail inherent in periods like COVID or big market drawdowns. But by definition, where these strategies can come under stress, we can provide some sort of buffer to that. And that was really Ryan Tolkien, who runs the firm's kind of calculus in bringing Colin and myself in to kind of offset some of that stress that they faced during the trickier months of COVID.
So then what would you say separates the greatest risk takers from the average ones?
Yeah, look, moving on to kind of PMs, I think the number one characteristic that the best risk takers have is phenomenal process. Like, they know how they make money. They have a real edge to what they do. They're able to construct and structure portfolios exceptionally well with a lot of diversified themes and bets across their book, and not just like in one or two things. They also have a very good sense around timing. Like, they have a good nose to identify when something's changing in the market, when opportunity is quite ripe, that other people aren't quite seeing, to get into things early. And similarly, when things aren't working, have an amazing ability to cut risk very, very quickly as well. Like, it's exceptionally disciplined. There's no emotion to it. The trade doesn't make sense anymore. I'm just cutting. And, I remember in my early days at Goldman, I was fortunate enough to meet Paul Tudor Jones as part of an interview. I was exploring an opportunity at Tudor. And it kind of really struck with me that all he really cared about were down months. Were periods in your career where you had drawdowns. How did you get out that drawdown? What was your mental state in that period? What was your process? And it really struck me that, risk taking is never an easy job, but in the best moments when you're making money, it does feel a bit easier because you've got momentum, you're high on confidence. It's like being a professional athlete. When you're hot, you're hot. But it's in the periods when you're not hot and when you're not seeing it and everything you touch doesn't seem to work, having that ability and mental discipline to kind of take your risk down or cut trades appropriately, and quite frankly, have the confidence in your process to know when to run the trades that will work and help you get out of drawdown, that is really important. And the best risk takers have a very good ability to do that. Like, everyone loses money at certain points. Everyone will have drawdowns. It's how do you respond in those periods of stress when your back's against the wall. And I've noticed the best risk takers often have an uncanny ability to do that really, really well, and a really high level of confidence in themselves and, their process that, gives them that mental fortitude to be able to kind of recover.
Yeah, so regarding portfolio allocations, right now we have a lot of uncertainty going on. The President Trump just came into office. Is inflation cooling off? Is it not? Are rates going to come down? Are they not? Are we risk on? Are we risk off? Obviously, you have the traditional 60-40 portfolio where you have 60% in equities, 40% in bonds and fixed income. How do you see or how would you be structuring a portfolio in 2025 or in the modern day? Would you be also involving some allocation to crypto? Because I mean, of course, this channel, we're very focused on crypto. Because obviously in 2024, crypto, Bitcoin especially, sort of it went from a contrarian to a consensus trade. We had the Bitcoin ETFs, the Ethereum ETFs as well. At Schonfeld, and on a personal level, how would you be structuring your portfolios now, or would you be going with the traditional 60-40 approach?
Yeah, a lot of questions there. So let me try and break that down a little bit. Look, in terms of like inflation, the top-down macro view right now, look, I think we're in a very uncertain time. Like you can see kind of from market gyrations, we've recently in this week just broken out kind of new highs in the S&P, but Trump won the election in November. It was more or less broadly expected. But as you've seen since he's come in, like just headlines all the time, and he changes his mind. It's tariffs, it's not tariffs, it's aggressive tariffs, it's reciprocal tariffs. The peace process with Ukraine has kind of kicked off in the last couple of weeks as well. But one thing that kind of sticks with me is that if you think about from 2020 in the last 5 years, the amount of global wealth creation has been unprecedented. Yeah. And the way in which central banks, when they have their backs to the wall in periods like COVID, what has become evident is their response function is exceptionally quick now, and they will, stimulate. They'll expand their balance sheets. They'll cut taxes if need be. There'll be much broader fiscal. These things are how central banks have learned to respond, especially post the financial crisis. And the only difference is that the response time is just much faster. If you think back to March of 2023, when Silicon Valley Bank went down, over the weekend, they essentially underwrote the entire banking system in the US. And, there was real stress at the time thinking about, well, is this another Lehman moment? We've got a major bank going under that, really was the bank that most kind of venture capitalist firms had been using. And, it was a pretty sizable bank in terms of assets and market capitalization with, potential ramifications for other banks and contagion effects. And the market was underwritten by the Fed, literally over a weekend, and stability resumed very, very quickly. And the Fed actually were able to continue hiking rates throughout 2023. But this mass wealth creation that has happened has meant that whether it's via stocks or credit or crypto or art or gold, like almost any asset you've looked at since COVID has pretty much gone up in a straight line. Not everything, but a lot of things have, and certainly that amount of wealth creation held in the hands of the top 10% is, 40, 50, 60 trillion, depending on measures that you look like. And, the average savings rate in the US as an economy is about $1 trillion a year. So you've had something like 50 years worth of savings created, over a 5-year period. And it's just unprecedented numbers. So I think what that means is that if you think about the consumption policies of the rich and how they generally tend to do that, they spend less on durable goods because at a certain point you have, you satisfied your appetite for kind of the amount of durable goods and TVs and, various other things that, you can consume. It's about services. And if you look at services inflation globally, it's remained exceptionally sticky. And, every forecaster has predicted, since 2022 that inflation is going to come down. And it has come down, but, inflation forecasts have generally been wrong. And we saw this week, CPI, core CPI in the US printed at 0.45, or almost rounded up to 0.5, way higher than anyone expected. And you can look through these numbers and, you can really pick them apart and you can say it's driven by, certain components. And, even last month's one was a softer one driven by owner equivalent rents and airfares and various other things like that. But underlying what kind of stands out to me is that anecdotally, I don't see a meaningful drop-off in inflation. And, this has been the view that I've held for, quite some time. I think the tail that the market is not pricing and really struggles to price is, can the Fed actually hike rates this year? I think it's very low probability. Powell's Fed's a very dovish Fed. They will cut very quickly if the economy does start rolling over. But, the labor market is exceptionally tight. I don't see anything in the data that really gives me strong conviction that they're going to have to cut. Now, look, no one is a particularly good forecaster of the future. Exogenous shocks can happen all the time, as we've seen. By definition, you can't predict these things. In those scenarios, of course, the Fed will cut, and they'll cut very quickly. But what happens if inflation just stays sticky? What happens if, financial conditions keep easing because the equity market keeps going higher? Because, any dip is essentially bought by, private wealth or, those that have a lot of cash in their hands. What happens if broadly the employment market stays very stable. For a number of reasons, it's very, very flexible. The U.S. employment market from just from self earnings in terms of people in jobs now, that creates about $5 to $6 trillion a year. That's 25% of GDP. I mean, these are massive numbers. Like $6 trillion a year is the equivalent to 2 times India nearly. I mean, these are big, big numbers that are being created inside the US from people in self-employment now. And these are kind of factors that didn't exist 10, 15 years ago in the same way. The amazing stat to me was, and I kind of chuckled at it, but OnlyFans content creators generated more than the entirety of the NBA last year. It's quite amazing to think that, YouTube creators, things that you're doing right now, like these ultimately can lead to like sources of income. Gamers, these are just things that didn't exist before, but are creating GDP in the US economy. So, more broadly, I just think the US has this very privileged position where the productivity of the economy, how strong like the labor market is, I don't think those things kind of come under meaningful stress that really create an environment where the Fed have to cut aggressively. If anything, the argument could be that despite massive interest rate hikes in the US in a very short period of time, economy's functioned exceptionally well. Nothing's really broken. Credit is very freely available. In fact, credit spreads are the tightest they've been in probably 2 decades. Again, I can't predict the future, but I do wonder whether or not this is just a new paradigm shift post-COVID, and actually the Fed's going to have to accept that, that 2% isn't really, the inflation target they should be looking at. Maybe it's 3%, maybe it's a bit higher, because inflation expectations and break-evens have been trending much higher even at the course of this year. Gold going up, I think that's kind of, partly due to some of these fears as well. So I think inflation's here to stay, and I don't think it's rolling over quickly. And there's a lot of people that would debate the other side of that, and that's what makes a market, but certainly that's my perspective.
Yeah, I mean, going back to what you said about the wealthy continuing to get wealthy whenever you have these money printing QE zero interest rate regimes. It's the Cantillon effect is whole when the rich or the ultra rich actually keep getting richer, and it's been like that since 2008. Where there's an interesting stat actually, which is that since the Fed was incepted in 1913, in 1913 the monetary base it was at $5 billion. Then between 1913 to 2008, just before the Great Financial Crisis, they had expanded the monetary base from $5 billion to $847 billion. Then between late 2008, just after the crisis, and early 2010, the monetary base was expanded from $847 billion all the way to $2 trillion. So that's around 100 years of printing in just under 2 years. And I mean, in 2020, we saw with the when COVID started to cause broader market pullbacks and severe corrections, the Fed's first course of action was not just to print money, but to print it at a much faster rate. And I mean, obviously in 2008, that's the first time QE was actually deployed. Rates had hit the zero bound, it's called. And then how can you stimulate beyond that? Quantitative easing. And now with inflation, like you said, it's very sticky. The unemployment market or the employment market is actually very strong. In September, when the Fed easing cycle started, it initially started because inflation was coming down towards the Fed's 2% target, and the unemployment market was, according to Powell, it was starting to weaken. But I mean, ever since then, we've seen, like you said, gold's been rising because it's basically been calling the bluff of the Fed pivot and the easing cycle. Because gold is an inflation hedge, and it's been going up as inflation's been going up. And now with the strong employment market and inflation rising again, you have to wonder, are we really going to see more rate cuts this year? Maybe. I mean, Trump's been putting pressure. I think now he's come out 3 times telling Powell and instructing him, also ensuring or providing guidance to institutions and regular investors that rates are going to come down. I mean, it's not really up to him. All he can do is put pressure, but also what he's doing with tariffs and how other countries are responding with reciprocal tariffs is really starting to have an impact on the dollar strength, because he's been placing tariffs on all sorts of countries. Most people, or the consensus idea is that tariffs are inflationary. You've seen previously times when tariffs have been inflationary for the first, say, 6 months, and then within a year and a half, inflation or the price of the goods which tariffs have been placed on has actually started to fall. within a year and a half. But I mean, that's obviously with a longer time frame. But what do you see as a driver of global liquidity and liquidity conditions in general in the US and the rest of the world right now? Because the dollars yesterday actually started to weaken, because while Trump's been placing tariffs, other countries have been starting to place reciprocal tariffs. So that's obviously caused the dollar strength to drop. The reverse repo market has actually hit the lowest point in years now, which shows money is actually being speculated with in financial markets. What do you see regarding global liquidity and all of that?
Yeah, so let me just, because you asked a couple of the questions before, I think one question that was important to think about was like kind of portfolio allocation. And I'll come back to drivers of liquidity in a second. But just in terms of portfolio allocation, I mean, look, the historical 60-40 mix was kind of the historical metric in terms of how people allocate. I think that's shifted quite significantly. You know, if you had a 60% kind of exposure in equities versus a 40% exposure in bonds, or vice versa, depending on, even call it 50-50 into 2022, that portfolio would have been smoked. You know, it was almost like, it was real just sort of anti-risk parity trade. Like, kind of risk parity worked very well, i.e. where you're long bonds and you're long equities, and pretty much, you know, all the way kind of through 2009 onwards, you know, as we kind of bottomed in March of 2009 post the financial crisis. But, you know, this was really the big unwind in 2022. And, you know, I think for the first time in a while, portfolios got, you know, pretty badly damaged in 2022. And then people may had to make a reassessment of what does the environment look like from here? You know, now look, I'd say holding duration-sensitive assets in your portfolio is trickier because, you know, the US is running a big deficit. Not that I think that matters a huge amount. It's about kind of just over 100% of GDP right now. You know, Japan runs a 250% deficit. Like, you know, and it's able to print its own, monetize its own debt. The market hasn't really questioned it that much. The US has a very strong central bank that has a lot of credibility. You know, its financial markets are the most liquid. The dollar's exceptionally strong and is the reserve currency of the world more broadly. It's hard to see, despite kind of all the doomsayers, why the size of the deficit today, at least, is going to matter that much, but it's something to keep in mind. But more broadly, I think the allocation mix is like, okay, you want to own some bonds because at 4 or 5% in money market funds, that makes some degree of sense. You know, for the best part of, you know, 12, 13 years, you've got zero rates in money market funds. Now you could be able to pick up 4 or 5% to take no risk and just kind of have it in a very liquid money market fund. Kind of explains why there's $7.5 trillion sat in US money market funds right now. But look, you know, the composition of equities in most portfolios has increased. If you think about just the composition of the S&P, even if you're holding the index, you know, 2024 alone, the hyperscalers, so if you think about kind of the Nvidias, Amazon, Meta, Microsoft, you know, these guys basically contributed, you know, almost 40% of the return of the 25% of the S&P. The 25% of the S&P was up, 40% of that was driven by these names. You know, Nvidia alone has gone up about 8 times over the course of the last, you know, since the start of, you know, 2023. So, you know, the S&P's composition has changed quite dramatically, where you've never seen a market as concentrated by these mega cap tech names as it has been historically. You know, 35% of the index is in these names. So you've naturally, your allocation, just being a passive investor in the S&P, has changed towards kind of these long growth, long momentum type names over the course of the last couple of years. Now, in my mind, I think your allocation should change and be flexible depending on the environment you're in. It's obviously hard, again, to predict the future. I think it's hard not to own the S&P in some format. It's the best companies in the world. It's got a 100% recovery rate. You know, if you go back to kind of the Great Depression, there's only been probably 10, 20% or more corrections in the S&P. And if you bought on every 20% correction and added another 20% lower and held, you'd be exceptionally wealthy. I mean, I ran some analysis actually, thinking about, okay, if you invested 100 grand in 1990, so you go back 35 years, and then every time you saw a 20% pullback off the highs, you put another 100 grand in, you'd have done that 9 times since 1990. And some of those would have been 20% down in the financial crisis, and another 20% down as we were down, you know, north of 40%. So you would have put in about $900,000. That today, in nominal terms, would be about $13 million. In real terms, obviously, you'd have to make some adjustments, and that's making some assumption for dividend reinvestment. But my point is that you've made like kind of 14 extra return just by being a passive investor and just adding on dips. So I think fundamentally, and I joke with a lot of my analysts, like your only strategy should be when the S&P dips is systematically buy those dips, or buy more when you have like a 10% dip versus systematically buying a small proportion every month. Because timing of these things is hard, but I just struggle to bet against these companies. And you think about these mega cap names, they've got huge amounts of cash on the balance sheet now, so they're only going to acquire more companies. They just have such competitive advantages that they've gained over the last kind of 10, 15 years from how dominant they've been. Unless there's some kind of government that comes in that's going to try and break up, these large companies, which, it's not impossible, but that's not happening in the Trump regime, certainly. That's very pro growth and, pro cyclicality. It's just hard not to have US exposure. Now, I also think in the current environment, like some Chinese tech exposure looks good because valuations are very depressed. European equities have had a big rally. There's a lot of negativity around Europe more broadly, but at these levels, they're not cheap, but they're certainly cheaper on a multiples basis than the US. The US is kind of in the top 90th percentile. I think the P is around 22 of the S&P. Doesn't mean it can't go higher, but I think you're not going to see. I don't think you're going to see a 25% kind of increase in the S&P this year, relative to what we saw last year, for example. But I think having exposure to some of these best companies, the best names, and importantly, not selling them on drawdowns unless something fundamental changes, is really important. Like the lesson of the financial crisis, the lesson of 2020 was that when the markets panic, if you crystallize those losses by reducing your portfolio, you'd be meaningfully down. By holding your portfolio or adding to that risk, especially if it's in US equities, you've done exceptionally well. And just in the crypto component, look, Bitcoin market cap is about 2 trillion roughly. Gold is about 20 trillion. It's about 10x. I'm making these numbers off the top of my head, but it's in that region. Can Bitcoin go from 2 trillion to, say, 6 trillion or 7 trillion, relative to what gold is doing? I don't think it's impossible, assuming it's a finite amount of it. Governments are looking at doing their own things, but I still think even if other governments introduce their own coins, it doesn't work that simply. I don't know if you saw, but over the weekend or over this week, Argentina under Milei introduced Libra. The market cap of that went up to 4.5 billion and then collapsed. So it's not that straightforward, even if it's supposedly quote unquote a government-backed coin. They don't really have the history and the staying power that Bitcoin now has. Call it over a decade of history, right? And credibility that's been built up with that. So, I think having a percentage of your allocation in, whether that's Bitcoin or whether that's Ethereum or whether that's something that has some sort of real world use ultimately, or real world assets, the tokenization is something that's becoming, a real focus. Makes some sense. Now, the amount you have just depends on your kind of personal risk allocation. My personal philosophy when I'm investing is to think about, okay, how can I generate somewhere between 7 to 10% a year? And if I can get 12% on average, great. How do I do that in a way that I try to invest in things that I don't think are going to have crazy amounts of drawdowns? And it doesn't mean you can't take more risk in certain components of your portfolio, but you want diversification. So the sum of your parts of your portfolio trades around a 1.5, 2 sharp, but tends to over time generate somewhere between 8 to 10% type returns and sometimes higher. And look, it's just simple math. That they say compounding is the 8th wonder of the world, but it's true. If you can invest at 10% a year on average and kind of just reinvest what you're making, you're going to double your money every 7 years. And for me, quite frankly, I don't really want to. I invest on a daily basis for a living. My own personal wealth that I've kind of, accumulated over time, I want that to be in something that I can sleep at night and not worry about and just allow that to compound. And that's really how I personally think about my own investing. And it doesn't mean that I don't make speculative bets from time to time. It doesn't mean that I don't look at VC bets, but they're generally outside, as with your father, some speculative crypto things where we have high conviction. I generally don't tend to do kind of really sizable kind of bets like that. There have to be something that's a smaller part of my portfolio that I don't kind of worry about. If it does go to zero, it's not ideal, but it's not going to change my life. And that's something that's really important to me because I don't want to kind of speculate with a lot of kind of hard-earned work.
Yeah, I mean, how do you calculate return adjusted for inflation? Because you could say it's based on headline inflation. So what now it's 3% in the US, or would you calculate it based on the rate in which the money supply expands? Because since 2008, the money supply of the US has been it's been expanding by 8% on average per year? Or would you, if you a really high standard would be the Fed's balance sheet, which has been, I believe, 15% per year on average over the course of the last 30 years. How do you calculate or determine inflation adjusted returns?
Yeah, so I'll tie that back to your question before, which was about kind of global money supply and like kind of impacts of that and kind of, central bank expansion. So look, on a personal level, I don't really think that much about inflation. Like, as you said, inflation generally outside the last couple of years has averaged around 2-3%. Yeah. I obviously care about my money not being eroded and, investors' money not being eroded. You've got to beat inflation ultimately and, think about the real rate of return you're getting. But look, if you can make 7 to 10%, even inflation adjusted, you're fine. So that's all I really think about. Like, what is inflation, on an annualized basis that you think, roughly it's going to be, and then think about what's your nominal return on any asset, and then you just subtract the rate of inflation to get your real return, and then think about it in those terms. In terms of like balance sheet expansion, you're right. Like, I think at the last count, if you look at the Fed, the Bank of England, the Bank of Japan, and the European Central Bank, like the balance sheet was about 25 trillion, right? And most of this happened, as you said, post the financial crisis. I mean, at one point, the Fed itself was nearly $10 trillion. Yeah. Now, some of these balance sheets have come off a little bit off their highs, especially as kind of quantitative easing ended, as inflation went up. And then if some banks were kind of reducing the balance sheet and allowing some of their purchases to roll off and not reinvesting some of the bond proceeds. But nonetheless, look, liquidity is still pretty abundant. And, it goes back to my earlier point that I think what central banks have learned is that in crisis, you've got to expand your balance sheet. And in the case of the Fed, where they have an exorbitant privilege, because of the fact, the dollar is the reserve currency of the world and US debt is still seen as being exceptionally stable, they can just issue more bonds. The market hasn't challenged that so far. Now, the question will come if the market actually starts questioning whether or not the US's kind of debt is sustainable. And we see it, like the market panics in these debt ceiling instruments. And, we had this issue in 2023 where the government had to essentially draw down on its checking account, which is called the general account, TGA, a big drain of liquidity from kind of, I think it was roughly 700 billion to almost kind of empty, because we had this debt ceiling impasse, in this period in 2023. Now, history shows it always gets resolved. Congress find a way to kind of, remove that cap, and then we kick the can down the road for 2 years, and we have this debate again. We're currently again in this debate. Yeah. The general account at the Treasury was topped up and kind of rebuilt up to 600-700 billion. That is now being kind of depleted again slowly. Most estimates suggest that come, June or July, that will run out. But by then, almost certainly the government will figure out a plan to kind of, again, extend the debt ceiling limit and kind of kick the can down the road. And that's just kind of the mechanics. Now, look, we saw in 2011 where this happened, the market had a big wobble. The credit rating of the US got downgraded. It happened again in 23 where the credit rating went from AAA to kind of AA with US debt. It didn't cause a major wobble in US fixed income more broadly because, again, lack of alternatives outside of US fixed income. But nonetheless, it's something that we got to think about. But just circling back to your question on liquidity parameters, like liquidity is very abundant, September showed there was one wobble in employment data in the summer, and the Fed cut 50 basis points very, very quickly. And, you can literally look at a chart of the 10-year yield. It kind of traded all the way down into that cut. Yields went, I think off the top of my head, somewhere like 370 or somewhere like that on the 10-year. And by early January, 3 months later, we're 100 basis points higher very quickly. So financial conditions eased as the Fed indicated they were going to cut. The Fed cut at the first sign of trouble. Markets, responded. Financial conditions have tightened somewhat since then, but overall equity markets have gone up a lot. Look, financial conditions are very, very loose still overall. There's no kind of shortage of credit. Private kind of credit markets are abundant. So there's a lot of kind of shadow lending outside of what was the main vehicle for lending, which are banks previously, which provides a lot of liquidity to the market. Labor markets are very strong overall, globally pretty strong. So there's not anything imminent that suggests that, liquidity is going to kind of dry up. And if there was a scare, the market's going to bet that central banks will ride to the rescue. Now, does it come to a case of moral hazard where ultimately they don't do that? I don't know. But I think, especially in the Trump administration, you can see the way that his rhetoric kind of unfolds. When the market's having a bad day, all of a sudden there's kind of more pro-growth, pro kind of equity market headlines. When the market's having a good day, he gets a little bit more emboldened to be a bit more aggressive in terms of policies. Like, he really does care about the value of the stock market, which is kind of crazy for a president to tick watch in the way that he does. But that is a world that we live in today.
Yeah, I mean, I've been saying that Trump, he basically measures the health of the U.S. economy based on the price of the stock market or the S&P. And Bitcoin's price is sort of his proxy to how people are reacting to his presidency and almost his acceptance rate. Is the price going up or is it going down? So, I mean, a few months ago when Bitcoin's price broke $100,000 for the first time, he said, "You're welcome." Because obviously, but now going back to what you're saying about liquidity and the Treasury General account, I mean, liquidity, like you said, financial conditions they're loose. But I mean, 2024, we saw growth in the S&P, crypto, most risk-on assets performed exceptionally well. Now I think the markets are trying to figure out what pushes us further beyond this point. And I mean, Powell came out saying that until rates are at zero, the Fed would not start quantitative easing. And I mean, it wouldn't make sense to begin quantitative easing without interest rates being already at zero, because QE is sort of a further stimulation beyond low interest rates. Now, of course, with the debt ceiling, do you think that the Treasury General account, if it's drained, because previously, like you said, it's caused an impact to the U.S. government's credit rating, but last time the Treasury General account was drained, we saw growth in risk-on assets. What do you think about what pushed us further from here? Is it the dollar or the DXY dropping from here? Is it the Treasury General account drain? Is it QE? What do you think?
Look, I think some of those things, arguments end up becoming circular to some extent. If you think about what happened in 2023, like, equity markets were at much lower valuations than where they were. So was the rally back in equities really driven by the TGA being drained? Was it just by a function of the fact that actually, valuations and multiples were on a 16 handle or 17 handle in 2023 versus the 22 handle PE ratio is today? I don't know the answer. Look, what I do think is that, as I said, I think 2024 will not be repeated in 2025. You can see already that, there's a lot more dispersion. The winners of last year are now the laggards. So if you look at the Magnificent Mag 7, outside of Meta, they've actually generally struggled. And you look at kind of the laggards of last year, be that China equities or kind of European equities, they've been the outperformers this year. So I think we're in a very different tape. There's obviously a lot of uncertainty around Trump policies and what that mean. I do think that the market has put too much emphasis on kind of the impact of tariffs and what he's going to do. It looks to me that he's using them much more as a negotiation tool, and the severity of tariffs that the market had feared has kind of subsided somewhat. It's already been kicked out, and the can's been kicked down the road until April and potentially even into the summer now to really understand that. So, as I think toward 2025, I think it's much more a trader's market. We're going to see a lot more volatility. I still think the overall trend is most likely higher in equities because, financial conditions are easy and people know that the second there's any sign of trouble in the US economy, the Fed will very quickly react to that and cut interest rates. Look, I think what kind of changes that narrative is, one, if the capex that these hyperscalers, it's something like 350 billion, the big four are really spending in terms of on AI, ends up, as we saw with DeepSeek, becoming a number where the market questions as, are we overspending simply because, were DeepSeek really able to truly create something very similar for a fraction of the cost? So then, by extension, does that mean that multiples are just too high in some of these names? We're pricing too much forward growth and can, incumbents essentially be challenged? I think the second thing is that the US exceptionalism trade is very entrenched. So, I think you can see, it's not that I think that it'll unwind, but I think you'll continue to see underperformance of that versus places where people are very underweight, as I already mentioned some of those names. And then I think the third thing is, what I worry about is that, what equity markets won't like is if inflation does accelerate from here. Now, we saw that in the 70s, we came off and then accelerated again. That last inflation print, I was kind of surprised that the equity markets kind of shrugged it off. They went down on the day and, since powered up to new highs again on Thursday, Friday. Some of that was because we had weaker retail sales and PPI wasn't as hot. But more broadly, if the market, for whatever reason, starts suspecting that inflation is actually accelerating, which is not the market's base case right now, but I think the market's not pricing enough of a risk to that, Could a hike be ultimately priced into the market? I think that would really challenge equity markets, in the short to medium term. So, it's not our story for today, but something that, I think should be on the radar.
Yeah, that makes sense. Thank you for joining us today, Mitesh. It was really nice to have you on.
Of course.
I hope you all learned something from this discussion we had today.
Thanks very much for having me. Look forward to continuing the dialogue.